Hey everybody, welcome back to Justin on Money. I'm Justin, and we've got some interesting things to talk about today. So really specifically, there's some videos circulating right now making making the claim that the Japanese bond market has entered a historic crisis. Okay, that rising Japanese yields are unleashing a global shockwave, threatening U.S. borrowing costs and potentially unwinding the global financial system. Now, I think that's a little dramatic, and I understand why it gets attention. I mean, that's why you guys are here. But it also is blending together several very, very different mechanisms. Okay. And I think you need to separate them, okay? Because the story starts to look a little different once you do, okay? So we're going to slow this down just a hair and talk about what actually is happening, okay? So let's narrow in on the core claim, okay? The argument basically goes something like this, okay? Japanese long-term yields are rising, okay? Japan is the largest holder of U.S. treasuries, okay? Therefore, Japan is about to destabilize global markets. Okay, so I've done a video on this before. It's basically a podcast audio on this before, and I think it's probably a good time to bring this up again, okay? Because it's extremely intuitive what we're hearing, but intuition is not how bond markets work, okay? The key question isn't whether yields moved, okay? Yields move all the time, okay? There's nothing new about that, okay? The question is why they moved and what actually transmits across borders. Okay, so let's talk about point one. Here's what I think we need to be looking at, okay? Moving does not equal panic. Okay, yes, Japanese 30 and 40-year government bond yields moved higher. Okay, I think that part is true. Okay, but context in the situation is crucial. Okay, ultra long bonds are designed to move with fiscal expectations. Okay, they are not anchored tightly to central bank policy at all. The Bank of Japan controls short-term interest rates and the front end of the curve, for better words. It does not promise to freeze the 40-year bond forever. When long-term yields rise, okay, that doesn't automatically mean loss of control. Okay, it means markets are repricing duration, inflation risk, okay, and future issuance. Okay, that's not panic. Okay, I think that's more price discovery. I would love to know what you think, okay, on that point. Point number two. Long-term debt moves with trust, not rates, okay? Here's a key distinction that often gets missed in a lot of these conversations, okay? Short-term bonds move with interest rate policy. Long-term bonds move with credibility, okay? They price expectations about future deficits, demographics, and fiscal choices. So when Japan signals looser fiscal policy ahead of an election, okay, it makes sense that long duration bonds reprice. That's not a shockwave. That's how the system is supposed to work. Okay, so that's point number two. Let me know if you guys agree. Point number three, okay, Japan funds the US is really a misleading frame, okay? You'll often hear that phrase, okay? Japan is the biggest holder of U.S. debt. Totally true, okay? Technically, it is true. Anybody can go and look this up. It's that's not what we're arguing, okay? But economically, it's incomplete, okay? Because Japan does not fund the U.S. government the way a creditor funds a borrower. This is where people start to get a little confused. Most U.S. treasuries held by Japan are held by private institutions, pensions, insurers, banks, making portfolio decisions. Treasuries are not just debt instruments. They are collateral. They are balance sheet assets used in funding markets across the world, okay? Selling a treasury is not the same thing as pulling funds from the US. Okay, it's reallocating duration risk. Tell me what you think about that point, okay? Point number 4. Why Japan owns treasuries in the first place, okay? Japan didn't buy treasuries out of generosity, okay? They bought them because treasuries are liquid, they are high collateral, high quality collateral, okay? And really easily hedgeable. Okay, many of these holdings are currency hedged. That means that decision isn't just about yield. It's about balance sheet efficiency, okay? A modest rise in domestic yields doesn't suddenly invalidate that logic. Okay, so that's point number 4. Point number 5, okay, the carry trade, again, is not a single switch. We've talked about this before. There's also a lot of talk about the yen carry trade unwinding, okay, but the carry trade isn't one giant leveraged bet. It's thousands of institutions, each with different hedges, maturities, and really constraints, okay? Higher yields at home don't cause a mass liquidation overnight. They change incentives at the margin, okay? Slowly, unevenly, and really selectively, okay? Some flows adjust, others don't, okay? And we don't need to confuse that with collapse, okay? We need to call that rebalancing. Point number 6, why U.S. yields are actually rising. We need to talk about the U.S. side, of course. U.S. long-term yields are rising primarily because Treasury issuance is large, okay? Duration supply is heavy, and I think investors are demanding more compensation right now for holding long-term risk. That has very little to do with Japan dumping treasuries, my opinion. Okay, Japan is part of the environment. Okay, not the driver. So if Japanese selling were the cause, okay, we would see disorderly auctions and failed clearing, and we are not seeing any of that. And if you guys are seeing something different, I would love to know. I want to know your thoughts. I want to know, am I making sense of this, or is there something I'm missing? Would love to know what you guys think. Anything you can add would be great. Okay, I want to go on to point number 7. Okay, and we're going to be pulling up some data here, I think, shortly, but the real shift, I think, happening right now is much simpler than what's being told, okay? The world is transitioning out of an era where long-term risk was artificially suppressed. For really over a decade, term premium was kind of just crushed. Now, markets are relearning how to price duration honestly, okay? And that can create some volatility. So it does not automatically create a crisis, okay? So another point I think it's important to talk about, what would actually signal a problem here? If we were heading toward a true systemic break, I think you'd see very different signals. I think you'd see failed bond auctions. I think you'd see broken funding markets for sure. Severe collateral shortages, and in central banks losing control of the front end. I don't see anything. Well, we're not. So let me know if you guys are seeing anything different. I think what we're seeing is an adjustment, okay, not rupture of the system. Okay, Japan hasn't broken the financial system. Okay, so if you came here expecting a different answer, I'm sorry, but I don't have any bad news for you. So it hasn't pooled funding. it hasn't triggered a collapse. What we're watching, I think, is a repricing, okay, a slow, imperfect transition as markets adapt to a new interest rate environment. If you want to understand markets, I think you got to look at the mechanisms, okay, that drive those. That's what this channel is about, okay? That's what we do here. So I wanted to make a quick video on this. I kept seeing this over and over again. What do you guys think? Tell me, where are the structural weaknesses right now? Is there anything that you guys want to know about that we can discuss? But as far as Japan is concerned, and them destabilizing the debt market, I don't see it. I just don't see anything. So let me know in the comments what you guys think. Subscribe, like the video if you want. And thanks for being here. I'm Justin, and this is Justin on Money.